we kick it into the fact that we're live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because he's got these genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Our community manager in the house today is here. Madison, welcome to the show. She is in the chat helping you out. Say hello to our fans, Madison, our family.
Hello, everybody.
And the star of the show, the man that they call the lifestyle investor, who wrote 10 commandments of how to invest correctly in, let's go speaker view, in this brilliant little book right here that GC picked up, I picked up. We are looking forward to dive into it with you. Justin, welcome to the show, man.
Thanks. Glad to be here. Excited to hang out.
Excited to have you on board for multiple reasons, man. As you know, when we met a couple of years ago, you left a great impression on me. I'm glad to be reconnecting in this venue, and to our community that is listening to the show on the podcast in your ear. We appreciate you being there, but you're doing it kind of wrong. You should go to nyais.com, join us live on Tuesdays and Thursdays, because it's as fun as it sounds. And I'm going to prove it right now when we do our roll call. You ready for the roll call, Justin?
I'm ready.
All right. Danny Davis, top of the afternoon team. Madison is saying hi. John Henning, good afternoon all. Anthony did a hello, everybody. Lee Bishop, the MVP of the Not Your Average Investor Show. He says, hey, Greg and Pablo. Noah Randari, hello, everyone. Greetings from California. Jen Filzen, the fairy godmother of the Not Your Average Investor Show community, is back from Seattle. Everett Pop Shapiro is here as well. Eddie Harris from Hotlanta is in the house. Who else? We got Bill Shields. Saludos desde Hermosa Duval. Saludos, Bill Shields. Good to have you. Stevie B is in the house. He says hello to all. Leslie Wilson is back. Leslie, we haven't seen you in a while. Welcome from Denver. Who else? We got Carl Thompson from Colorado. We got Ken Moline, the patriarch of the first family of the Not Your Average Investor Show community. He's here. We got Drew Barnhill, man, absolute rock star regular and fan of the show. Leonard Lee, who traveled all the way from Mountain View, Googletown to Seattle to assist our IRL meetup, is in the house. Shelly Johnson from B-Town, Bradenton, Florida is here. Peter James from the esteemed Commonwealth of Virginia. Esteemed T. Peter James. We got, so else is here? We got Mitch Garcia is back. We got Marie Rockoff. She's back. Welcome back, Marie, from Scottsdale, Arizona. Dave Blattner from Massachusetts. Dave, is that a new name?
Might be.
New member of the community,
New name
Dave?
alert.
Yeah, new name alert. All right, good to have you, Dave. All right, Justin, that's a little thing that we like to do to welcome the community. And now we're going to talk to the star of the show. And, you know, man, first of all, we met a couple of years at a conference, kind of have kept up with your journey. And then all of a sudden, I think it was about 2 years ago, I don't know the exact date of the publishing of this book, you come out with this thing. I immediately sent it to Greg, because it's one thing to be a investment class subject matter expert. It's another thing to be a kind of expert on investing in general, right? Like Dennis Shapiro was last week. It's another thing to be somebody that creates your own investing framework, like the Nassim Taleb move, the Warren Buffett move, the Justin Donald move. Justin, can you tell us, you know, how can you be this audacious? Like what made you have to come up with this proprietary framework that you created with the lifestyle investor? What did you see in the world that needed this?
Well, first of all, I love the energy of the show and how much fun you have with your community. So I just want to, give you guys some props. This is awesome. Secondly, it's very flattering to be mentioned in the same sentence with some of the big names that you mentioned. And my goal is to offer value, but in no way, shape, or form measure up to those huge, wonderful names of people that have done amazing things in the world. For me, the reason that I created the framework, it's interesting. I lived kind of behind the spotlight in the shadows for a long. My friends, many of my really good friends, had no clue about the investing success that I've had. My family really didn't. Most people in my world didn't. And there's something nice to kind of, no one really knowing about you. And it keeps this level of privacy, and, it's just simple. But I had the friends that did know about some of the success that I've had really lean on me and say, hey, you need to get this message out. And for a long time, I said I would do it, but I wasn't sure how. It wasn't a huge priority. And so I kind of just slow played it for a while. And deep down, I always wanted to write a book, and I didn't know what I was going to write it on. I just knew a long time ago, I had this awesome session with Matthew Kelly where he encouraged me to write a dreams list and write down 100 dreams that I had to accomplish in my lifetime at some point. And one of them was write a book. And so this is before I looked at myself as a successful investor. I had some success, but I didn't attribute what I did and kind of the methods that I had to, the kind of the bigger picture today of all the, now I've got history. And so when I thought about writing a book, it's just a big, audacious goal. I'm not an author. Like, I don't just sit down and write. Like, that's not my thing. I don't know that I take great joy in that. I don't know that that's relaxing to me. But one of my good friends said, "Hey, Justin, people have been asking for a long time to teach what you're doing, and, to have, to really just give your framework and methodology. And if you won't do it for everyone else, will you at least do it for your daughter? What would happen if you died and she didn't learn any of these methods that you have, and it just got lost?" And so that really, for me, pushed me over the edge. Before it was kind of like, oh, I'll get to it. When he had that conversation with me, I started writing the book the next day. And I didn't write it like most people do. I hit voice memo on my phone and then just recorded a whole bunch of my thoughts that eventually were transcribed into the book that you see today.
It's funny. So Justin, as Pablo and I we run every Tuesday and Thursday at like 5 o'clock in the morning. And he's been talking about me having the opportunity to meet you because he's like, Greg, you think just like Justin does. He's like, he's like, Justin's a wonderful communicator. He's like, I know you guys care about communication. He's like, if there's anybody that's a guest that I think literally you guys are occupying the same mental space, it's Justin. And so as you're talking about your journey to writing a book, I can relate with having a message that I'm really passionate about, but slow playing it. If anybody's been a fan of the show or in the group, you guys can probably call me out now because I've been slow playing it. You even talk about Matthew Kelly as an influence for you. Matthew Kelly has been one of the most influential authors to influence JWB and me. He also wrote The Dream Manager, which is a part of writing down 100 dreams. And the Dream Manager is a program that we have here at JWB to help people accomplish their goals and their dreams, even beyond what it means to have a career here at JWB. It's a wonderful book. My thing is, as I started to read your book too, and I'm like, man, you know what? I feel the same thing about how investors get it wrong, right? As investors, most investors are wired to, measure their success in return on investment. And for me, sure, that's important to understand, but at the end of the day, I'm trying to create the lifestyle that I want. What does the lifestyle investor mean to you? And why do you think most investors get it wrong?
Real quick, before I dive into that, I just want to give you, since you guys are already in this space and kind of love the Dreams Manager focus, one of my friends, Dane Espegard, had this amazing message in his head that he wanted to get out. And it took a while to encourage him to write a book. And he wrote a book called The Dream Machine. And he has a whole methodology of helping elicit that. He runs workshops and sessions for corporate America, for investors. And so check out his book too, because it's an incredible read. And I had him come speak to my mastermind, The Lifestyle Investor, and we did a whole workshop with him, and it was incredible. So I feel like Matthew Kelly 2.0, and I think you all enjoy it.
Love that.
So to answer your question though, I think where most investors get it wrong is we have basically the largest lobbying campaign ever called Wall Street that is peddling a message that is really good for Wall Street and is really not good for the people that are investing. And so you've got the richest organizations in the world that even when they fail, they don't really fail. They're an extension of the government in many respects. And I just see so much misalignment between financial advisors and money managers and the people that are actually managing, having their money managed. And I don't like when incentives are misaligned. I don't like when people make money when I don't make money. I don't like that. I don't think that is right. And I think that it creates a different motivation. And so I think most of our financial system is based on this misalignment of, hey, give me your money as much as I can get you to give me, as frequently as I can, and to get you to not take it back for as long as possible. And I also think that there's a misrepresentation on statements of what really happens. And so you've got this total misinformation, this miseducation that exists, that the masses, I guess, assume to be real or grow up to believing is real. And it's just not the case. So I think most investors have it wrong because their whole thesis is wrong. Their whole thesis is, hey, let me build this nest egg until that it's so big I can either take distributions from it and never whittle it down to zero, or I can get it big enough that I'm just taking the interest from it and I can live on it. But the reality is that doesn't work, or it works for such a small percentage of individuals. But the problem is you don't realize it doesn't work until you go to retire. And then you realize how much the government actually gets in taxes, which you probably didn't realize, that probably half of the money that you're saving is actually going to them. And so then you've got investors that maybe take a different direction. And in the last, 10 years, 15 years, everyone seems like they're a genius because it's hard to do wrong. So now you have people that are experts who really aren't experts. They haven't weathered a financial crisis. And so you've got people with these really gross terms where, again, there's misalignment. You have, these syndications, these money raisers that make a lot of money, even when their investors don't make money.
Right.
And some of the splits, some of the structures are no good. So I feel like it's hard to get it right when there's so much misinformation and there are very few people speaking the truth. And so the whole idea of my book and what a lifestyle investor is someone that has decided that they would rather focus, instead of living life on default, that they're living life by design, that they're being proactive, not reactive. And they're, instead of saying, when I ask people, hey, what if you had all the money in the world, what would you do? Most of the time people say, well, I don't know what I would do, but I'll tell you what I wouldn't do. Right. And then they list all the things they don't like. People have so little clarity for what they want and much more clarity for what they don't want. And so I think we got to shift that focus. So my goal is, how do I teach people to buy assets that produce income and enough income that it covers their lifestyle? So now you don't have to work for money, because when you make decisions based on money, I think that it is there's too much that complicates that decision, and it's not the strongest decision-making space. I think when you have money taken care of, your expenses covered, and you can live a great life, you're going to make different decisions, and those decisions are going to direct your life.
I love it. I love it. I'll just chime in as you're talking about this fallacy of everybody trying to get a big enough pile of money to somehow live on that and retire and all that good stuff. I think about, you talked about how it's normalized to try to do that. You ever see that ING Direct commercial? They would just, it was a commercial.
The number?
Yeah. Right. Your number, right? They would say, oh, do you know your number? Do you know your number? And they would have people walking around with like 1,452,000 or whatever following them. Like it's just very, like you said, right? It is hard to achieve that and it's just inefficient to try to achieve it that way. And there is a much better way, but you have to break free of the norms, or what the way that Wall Street and the stock market and more traditional asset classes would tend to try to make you believe is the norm.
Right. And think about it this way. If you buy assets, those assets are going to appreciate in tandem with the money being printed. So you're hedging against a devaluing dollar. If you sit in cash, you're losing money. If you buy assets, then your net worth is growing at the same degree as the money being printed. And then you're earning cash flow that you can live on. That is really like very foolproof versus, let's say you've got this number that's following you around, and maybe your number is 5 million or 10 million or 20 million or 3 million, whatever your number is. That's in today's dollars. That doesn't take into account that we just had the largest inflation in the last 40 years at 7%, which is not even a real number. It's for sure 15 to 20% based on how much money is being printed. It doesn't take into account the fact that taxes are going to have to go up because we're more in debt than we've ever been. It doesn't take into account that the US dollar may not be the reserve currency of the future. It doesn't take into account there might be a market collapse at the time someone retires, leveling out or cutting in half their total net worth, since most people put the value of their assets, the vast majority of their portfolio in the stock market or in qualified plans. If it's not, directed into their business, a lot of entrepreneurs will put it all in their business and risk everything on their business, hoping that works out. And then everything else goes in the stock market. But it's like all these factors, like if you're retiring in March of, or let's just say the financial crisis of 2008, if you retired then, like it took, people aren't even back, 25, 15 years later.
Yeah. And then even if you get this big pile of money, you're at retirement, it took you that long to earn it, you're going to go into really conservative investments at that point, which you're going to be in asset preservation mode. So like you work way inefficiently to build up this pile of money, you get there, and then your choices for what you want to invest, because you got to play defense because you're 60, 65 years old, you're earning a small fraction of what you could have earned if you had done it differently. I knew we were going to occupy the same space.
I love being part of this conversation. A couple of things in the chat. Jen is celebrating her 5th rental property. Congrats, Jen.
Hey, yo, way to go, Jen.
Closed it in Seattle, and also dropping the link for our Denver in-person meetup on April 30th. That's in the chat as well. Hope y'all can join us. The other thing I wanted to double check there, Justin, your friend who wrote The Dream Machine, what was the name again?
Dane Espegard.
Dane Espegard, for everybody to see. I know Anthony did already purchase the book. Just FYI, Justin has a friend that has published a book on just about every single topic. Every time I talk to you, you're recommending me a friend that wrote a book on something, right? Like The Culture Code I just read, which is your friend as well. It was awesome.
Well, now that I've written a book and I've gone through the process, I just feel like everyone who has this stored up in them should probably write a book and get it out there, So let this be another message to you, Greg, to get your words of wisdom out to the world.
Love it, man. I appreciate the accountability, brother.
I need somebody helping me rally that cry, Justin. So I appreciate all the help I can get, man. Listen, so we are big fans of frameworks here, right? Like we tried putting out our own framework, this like investing scorecard that we like to, when we have guests that are asset class experts, run them through this kind of scorecard of the way that we value things. With you, since you have your own framework, what I would love to do is our community is very educated in rental properties, right? So I would love to put rental properties through the lens of your 10 commandments. And, that way they'll get a good idea of what they're going to get from the book and how they're going to learn to do that. You up for that?
Sure. Yeah, you bet. I've got a lot of thoughts on it. I'll let you kind of spearhead it. But even in the world of real estate, there's so many different directions you can go, right? In the world of real estate, I love real estate, but there are good buys and bad buys. There's overvalued, there's undervalued, there's cash flowing, there's non-cash flowing. There's just so many different categories that we could go into. But overall, it's a no-brainer. And I know that you've got definitely a real estate minded group of individuals. I think it's good just to share. I've studied the wealthiest people in the United States, and I have in the world too, but I've done a lot deeper of a dive in the United States. And most of your ultra wealthy, high net worth individuals have a portfolio that is 50% or greater of real estate and private equity. And so in many cases, it's an even split, 25-25. I've seen it weighted a little bit more. I've seen some people come in heavier and, really be on 50% real estate. But I just think it's important to recognize that this is so important, the education you guys are doing. So I'm totally up for this. I just wanted to kind of give that overall framework of kind of what I've looked at with the highest net worth people, in the United States.
Awesome, man. That's super valuable. Thanks for that scope. I hadn't really thought about that. And I was, kind of thinking about, I've recently over the last year or so purchased a couple properties with JWB as well. So I'm like, in my head, I'm pulling forward demand to get into this asset class because it's so good right now. And then I'm going to diversify a little bit more. But the idea that being 50% in cash flowing real estate is a good measure of where you want to be in overall assets is super, super valuable, man. So I appreciate that. I was just kind of going to go through the commandments, right? Like you got these 10 commandments, always think lifestyle first, always find a way to reduce risk, watch for invisible deals, get your principal back quickly, create immediate cash flow, find income amplifiers, always look to plus the deal, cut out the fat on investments, use leverage advantageously, and make every dollar work for you. Let's start at number one. When it comes to, and another piece of context, right? We differentiate here on the show the idea between turnkey rental income property investing and completely vertically integrated rental property investing, right? So I think Greg will probably shine a little light on that. But as far as always thinking lifestyle first, turnkey rental properties, how does that measure up in your head of adhering to the commandments or not?
Yeah, it's interesting. I almost feel like you got to split it into two categories, because are you owning the deeded property yourself, or are you having a group that's running, managing, scouting? So to me, I'm going to look at it through two different lenses. I think either can create lifestyle. I think either can create better or more lifestyle than maybe what someone has. For me, when I first started investing, I was building a business, and that business took a lot of time. And in order to replace that income, it took way less time for me, owning my own deeded property. I own mobile home parks. That's how I got started. And so for me, it was a total upgrade. I was able to replace my income working way less time, but I was still working. It wasn't totally passive, but it was way closer to passive, versus if I went with a syndication like today. We've got an operation and a team that kind of handles all of our real estate. So anything I buy truly is passive today. But if I didn't have that team in place, and I do a lot of syndications and funds, that is truly passive. And so, yeah, those pass with flying colors.
Love that. And just to give you a little bit more perspective on the folks that are on the show right now, they're more in the passive camp. Right. They would never actually call themselves real estate investors. Most of them, if they introduce themselves at a party, and they obviously they work with JWB to be that, boots on the ground, that vertically integrated team that can control all aspects of it. And, they work to, of course, do the due diligence and then get to a level of trust for us to handle that. And they really enjoy that complete passivity. So that would be great to kind of assume that that's kind of that's going to be the angle that we'll take as we're kind of going through those 10 commandments.
Well, I think it's smart because you're buying your time back. Like my whole thesis with becoming a lifestyle investor is that you truly buy your time back, and you can spend it how you want. You can spend it focused on your gifts and the things that really light you up the most, and the relationships that are most important to you. Right. And so, when I was early on in my career, I bought real estate that I managed. I felt like I needed to figure out how to do that, to know how to find someone that I trusted. So I made a bigger return, but it cost me time. Today, I would trade in a heartbeat the extra return to have the time back and just have someone that I trusted run it and manage it. And so my goal today is that I never have to put time into any of my investments.
I love that. Whenever I used to go and buy a rental property, people would say, "Oh man, you spent this amount on this," or folks that are friends or family, like, "How did you spent this amount of money to buy this rental property?" Right. And largely we invest in below middle income housing. So they're like, "You spent that on that?" And for me, I understood how this was going to help me accomplish my lifestyle goals, really. And it was never about the money that I would be earning on it. It was about the time that I would control. I bought about 40 rental properties in 2006 and 2007. And every time I bought that property, I was like, all right, call it, I'm buying an hour a week here, right? And I'm not realizing it right now. It may take 10 years for me to fully realize this, or 15 years, but I'm buying that time. So I can totally relate to that. The interesting thing that we do, Justin, I love your advice and thoughts for the community here, is we go the syndicated route, we go the passive route, but it's not a syndication. Our clients and myself, we actually own the properties. So it's a little bit of an in-betweener there. What thoughts or advice would you have to make sure that you can be passive, but also, of course, own the asset? You have more control there. What do you like, and what have you seen people fail at?
Well, I think to a certain degree, some people don't make the move because there's too much unknown. And so they miss out on great opportunities. I think most of the learning comes in just doing it. I don't know that I've ever been prepared enough to do the thing that I'm doing by prepping ahead of time. I mean, I'll do the best prep I can ahead of time. I think that the real magic and the real education comes when you have to learn, like you're in a situation and you have to figure it out. So, I mean, I like your guys' strategy. I also like owning deeded property because you have the tax write-offs there. I mean, there's just so much in the realm of positives that happen when you actually own the real estate and have control.
Love it.
Cool. All right, let's go. Commandment number 2. Commandment number 2. All right. Always find a way to reduce risk. How do you feel about that when it comes to turnkey properties?
Yeah. So with risk, I think you've got to look at it a few different ways. Number one, I love real estate because, well, if it's turnkey, then you don't, in theory, have to put much extra into it. I mean, you might, and you may not have caught something in due diligence, but generally you don't. You pay a certain amount and then you've got cash flow coming in if you're buying cash flowing assets. What I really like about it is generally like an asset's not going to go to zero. And even if it did, if it burned down, you've got insurance. So, there's replacement costs, in there. But what I do still think is important is there's risk on borrowing and being over levered, right? And so, and then making sure that you've got good terms. So if you're buying at a certain cap rate and then you have an interest rate that is at that same cap rate, that's pretty risky. So trying to kind of, game the spread and get 2% or 3% of a spread, I think is really nice. And then the other thing is you got to be careful. Some people invest for appreciation and we just don't know what's going to happen in the future or how long that's going to take. So if you invest for cash flow, then it doesn't matter how, if the economy crashes, that's okay. You've got cash flow to cover it. You're not forced to sell like someone who's not cash flowing, right? So there are a lot of ways to de-risk it. Real estate in itself, like a stock could go to zero. Your real estate's never going to go to zero. The worst things can happen in the world and there's still some intrinsic value in it and you get the write-offs on top of it. So it's pretty de-risked, but I think you also have to be careful on the leverage side, which we can get to in, a little bit later.
Yeah, I love it. I always talk about cash flow as being the entrance to the dance when it comes to a successful rental property investment, right? It's something that you have to require before jumping into this because I think simplistically about what is an asset versus what is a liability. And if something's paying me every single month, that's positive cash flow. That's an asset. If I have to pay something every single month, that's a liability. And I don't want to stack those up. I want to stack up assets. And then you talked about what would happen if the market turned. I actually bought those 40 rental properties in 2006 and 2007, as we mentioned. And I'm one of the few people in the entire country who made those decisions to buy 40 rental properties at that time, who still owns them, right? And who has bought more. And the only reason that I was able to do that as a fledgling entrepreneur at 23 years old without, stacks of cash backing me up and without experience here is because I reduced the risk, just like commandment number 2. I bought with positive cash flow as a requirement. And then what I allowed is for time for those other for-profit centers to do their thing. And then interesting, you talked about home price appreciation as well. You mentioned we don't know what it's going to do in the short run. And I absolutely believe that, right? We have to go into it if we're going to be buying rental properties and you want to maximize all 5 profit centers, you got to be in for a full market cycle, right? You can't count on home price appreciation. So if you are counting on home price appreciation and you are not requiring positive cash flow, you are way too risky in rental properties. And that's how most people got burned, especially as the market crashed in the past.
I think it's interesting because Justin, I've listened to you speak on multiple podcasts and you talk about de-risking the deal as it's never going to go to zero. But Greg talks like weekly on de-risking the deal as like ensuring that it's positive cash flow. So I wanted to just kind of call that out to our community and that there's more than one way to de-risk a deal and to assess that stuff. And I don't want to get too far ahead to commandment number 5, which is cash flow. But since we're there, let's just jump right into it, right? That is commandment number 5, create immediate cash flow. How do you see that, Justin?
Yeah, to me, I think that so number 1, I mean, turnkey is great because you're cash flowing. And I think that that's the foundation. I mean, a lot of your financial advisors and money managers say, oh no, your foundation is to max out your qualified dollars. And you want to get, max out the tax deferral when likely it's going to be at a higher interest rate, a tax rate down the
yeah.
road. I think the foundation should be build your cash flow to cover your survival income. That should be number one. Like, what does it cost you to live? What does it cost you? And this is super bare minimum, but your mortgage, your car payments, maybe if you're just eating, ramen, whatever, like super bare minimum, what does that cost you on a monthly basis? And then build the cash flow to that, then build the cash flow to, like your current lifestyle, and then build the cash flow to maybe your ideal lifestyle, or maybe what it is that you're pulling in at your day job, or what you're pulling in at the business that you're running. And it can start small. It can start with like, hey, this deal covers my utilities. So every month, my own personal home utilities are covered. That's great. And then buy another one that, covers, your car payments, and then buy another one that eventually covers your mortgage. But yeah, I mean, cash flow is imperative to me. Now, once you have cash flow and once you're covered, then I actually think you should consider other options. I don't think that having everything in cash flow makes sense either, but I do think that that's kind of like the first stop.
Love it. I love it. Cash flow helps you live the life the way you want to live, right? If you have a lot of money on paper, but you don't have cash flow, you're still not making lifestyle decisions based on, how you would draw this thing up, right? If you have a cash flow coming in, that allows you to say, you know what? This job, these hours, these other things that I'm doing in my life, do I want to do that? Do I not want to do that? Now you have the option. So cash flow, and I really like the point that you made that I love every point you made there, right? I love stacking the cash flow wins, right? And I love attaching it to your cell phone bill or your utility bill. We have clients that have done that same thing. It's such a fun process. Well, I've knocked out the cell phone bill. Now I'm moving to, whatever it may be. But then you mentioned once you reach that goal, when you invest so heavily in cash flow, sometimes you give up growth opportunity, so once you get to that goal, it might not always be all cash flow, right? We might then have that ability to go ahead and think about growth and think about some more, another way of saying it, slightly riskier ways to grow wealth faster because you covered your nut.
Yeah. And just to pile onto that, I think it's really important to, like, if you're going to make risky investments, instead of using the principal dollars that could earn you cash flow that you need, why not risk the monthly cash flow that if the deal goes bad, you still get cash flow the next month, right? So that to me is like, number one, gamify it, right? So figure out a way to make it fun and accomplish. And then number two is, it is good to diversify. And with that surplus, once you go above your lifestyle or your ideal lifestyle, you've got surplus income, and then it's figuring out kind of where to go from there. And in some cases, you might have so much income that you need real estate to be able to offset your income, because if you can keep buying and you can get your income to zero, a lot of people in my network and my mastermind, and for me personally, we generally pay anywhere from 0 to 12% effective tax rate. And for many people, I mean, it's, we pay nothing in taxes legally. But what happens when you get beyond that? What happens when you don't need to buy the real estate to have another deduction and you've got enough cash flow? Well, how do you look in healthcare? How do you look in technology, in SaaS? How do you look in cryptocurrency or Bitcoin? How do you look in, so we can in private equity in general. So you can look at all these different ways of earning, what's your senior secured debt position? Like, what percentage of your portfolio do you want in all these things? But I just think the foundation first and foremost is buy assets that produce income, that get you to the income level that you need to be at. And then from there, make more decisions.
So this is great, man. Like as a marketer, I'm looking for signals, right? The amount of people in the chat talking about how you're dropping golden nuggets, and Chris Gonzaga saying, I am listening, and great way to think about your cash flow point from Drew, right? Like, this is why they call you the investment world's new Warren Buffett, right? Like you're an expert communicator and getting this to land. For me, it's like, man, what you talked about of just like the bare minimum lifestyle. I'm just like, all right, man, I can live off of $2 $5 footlongs a day. But at the end of the day, I like to shop at Whole Foods, right? So it's like my bare minimum is, can I cover that nut? My real lifestyle is doing my grocery shopping at Whole Foods because I like to eat organic and I like to eat healthy. And then once I get there, now I can start messing with higher risk, giving up cash flow, those types of things, right? Like it lands really, really cleanly, man. I'm really enjoying this. So let's go to number 3. I think this is where it starts getting a little more difficult to tie it into what we're doing, and maybe, it doesn't give us a great report card, but watch for invisible deals. Can you explain what that means and how that might either make this asset class look good or bad?
Yeah, in general, when I look at invisible deals, I'm thinking of all asset classes, right? So I just want deals that no one else knows about, so there's less competition. This could be in private equity, it could be senior secured debt, it could be, a royalty agreement with an organization, but it could certainly be any and all real estate. And so when something is on the market and you've got 50 different people bidding on it, it's hard to get good value. I mean, I love buying things where I know that I made money on the buy. Like I'm already in the money and then everything else is gravy. And so I love finding a way to eliminate that competition. Now, that doesn't mean if it's on the market, it's not a good deal. There are plenty of things on the market that are a good deal, but can you find the homes, the apartment complexes that are not listed, that maybe it's a baby boomer that is ready to retire and they want to sell it. They've got a number in their mind. They don't really think about it in terms of NOI. They just have this number that they want to get. And if you'll pay that number, then they'll sell it to you. And, the relational capital that comes into play, they're not looking to maximize the dollar. They're looking for someone that they connect with, that they like. And so, that relationship, I bought so many properties, with that mentality and that mindset. And that's a true invisible deal because no one's bidding it up. No one knows that it's for sale. It's closing before anyone else knows. That to me is the beauty. But at the same point in time, invisible deals can be picking up trends of, what's going to happen in the future. So for me, I like to kind of track with like e-commerce. I got into e-commerce super early. I got into cannabis, hemp, CBD investing super early. I got into crypto, Bitcoin super early. Like I'm trying to find the trends. And to show you how early I got in on single family homes, I started investing in these before they were recognized as an actual asset class. And I built a company that services the largest institutional owners of single family homes in the US, all the largest, but because the trend was homes for rent, right? Or even now rental communities. And so if you can spot what is going to happen, if you can spot the spending patterns of, millennials and the next generations, you can be ahead of the curve for investment sake as well.
All right,
You or me?
I'm gonna just jump in here. Just, I mean, if you got stuff to do it, I'm gonna ask them something else.
Go for it.
You gave this awesome story in another podcast of yours I listened to of a trend that you spotted during the pandemic when it came to people buying dogs. Can you tell that story, man? That thing's epic.
Yeah. So this is a fun one because this is a total invisible deal.
Yeah.
So just as a disclaimer, I don't own a dog. I've never owned a dog. I know nothing about dogs. I would be, the worst dog owner. But during the pandemic, I noticed that all my neighbors bought dogs, and every one of my friends that said I'll never own a dog bought a dog. And then all my friends that are like, I'm never going to get another dog, they got another dog. And so everyone's buying dogs, and these dogs are just, chewing up, everything. And I just thought to myself, gosh, what a great market. People are going to need to train their dogs. So I bought a dog training company, knowing nothing about training dogs. But I bought a company knowing that there was a salary in place that the previous owner had that was high enough that I could bring in an operator. And so I brought in someone that I had, a friend who I'd worked with in previous businesses. And I wanted to help him and his wife get out of corporate America and get out of the rat race. And so I was able to pay him $10,000 a year more than what he was making in his corporate job. And so he came over, he ran it. I gave him a whole bunch of equity as well. And his goal was to, grow and scale this company. And so, while running it, by the way, side note for any of you football fans, Patrick Mahomes trained his dog at our studio, which is pretty cool. And it's in Kansas City. And so we ended up taking this business that, we bought for nothing. Like I put $100,000 down My lender lent us the rest. I think it was like $480,000 or 500. It was less than $500,000. I think it was 480,000. And then we grew profit we had a stretch where we were profiting between $10,000 and $12,000 a day in this business, which is just crazy. And that was unsustainable because we would have had to, in order to keep it up, we would have had to open more locations, get a bigger facility. I mean, we were booked out like 8 months in advance, but that's just how much demand there was, like how eager the market was for this. And again, I was a total, equity partner, capital partner. That's it. I did no operations. That's my whole thing. I will invest. I'll be the capital, but I need to find people that can run it. And so I did no work on this. I just gave some advice here and there and hired someone that was more than competent to be able to run it, who did a great job, exceeded expectations. And we ended up selling that business and made 11x on our money in a year and a day.
Let's go. How good is that?
That's pretty awesome.
Yeah.
That's incredible.
Thanks for sharing that, man.
Yeah, man.
I'm proud of you.
Yeah.
Congratulations.
My pleasure.
Yeah,
that's
cool.
a fun one. But that's what I mean. Like some of these deals are not down the fairway. They're in the rough. Like you would never think that this could be a good business. And a lot of them are just the businesses that are not sexy. I mean, I got into mobile home parks early. They're clearly not sexy. That is as unsexy of an asset class as you can find. But at the same point in time, if you can look past the facade, if you can dig down into the numbers and see the opportunity, that's where the treasure is. That's where the magic lies.
But you don't have this big number following you around, Justin. I mean, what, don't you miss this number?
Well, the beauty is once you get to a certain point. So I remember what it was like with my first investment, and it was nerve-wracking. I mean, I lost sleep. I was going crazy. I was like, am I making the worst decision of my life? Like, am I going to lose all my money? Is this a money pit? I mean, these are all the thoughts that I had. I would wake up in the middle of the night sweating, thinking about this. And it's the fear of the unknown. And I just rested on the fact that if someone else can do it, I can do it too. And I'm just going to copy their playbook. So, I mean, maybe I'm not as good, but I'd probably be 70% as good. And 70% is good is a heck of a lot better than where I'm at and what I'm doing based on where I want to go. And so, that brought a lot of confidence. But what's interesting with money is once you have it, it becomes way more of a game, and you make decisions that you probably should have made a lot easier. So when you're living in this scarcity minded space where it's like, this is all my money, I don't want to let it go. It's so hard to let it go, because what if I lose it? It's like you're gripping too tight. How are you going to, if you aren't going to let it go, it's like a bar of soap. If you're trying to wash your body, you have a wet bar of soap, you're in the shower and you squeeze that thing as hard as you can, it's just going to pop out of your hand. Right. The way that you can't control it, you kind of massage it, you influence it. And that's how it is with investing. So instead of holding on to money so tight, it's like, hey, let's try and put it to work. And it's not like we can't earn more money in the future. So if things go wrong, and by the way, things are going to go wrong, can you learn lessons that help you make a better return the next time? And so I've tried to get out of the space of like good decision, bad decision. And I try to live in a space of, okay, I made a decision. There are pros and cons to that decision. And once I learn, some of the, the things that happen by default from this decision, I'm going to have more information to make an even better educated decision on the next decision that I have to make. And so that way I'm not penalizing myself like, oh, that was such a dumb move. I don't want to do that. It was like, wow, if I could do that again, I would do it differently. But now that I know this, I'm so much more equipped for next time. So I'm actually really thankful for that lesson, even though it feels like a punch in the gut today.
It's about the journey. I mean, that's what I'm really hearing for you, right? And sure, there's the dollars and the cents and the return on investment from that investment, but there's the educational experience that even if you strike out on this investment, you are going to be better suited for that next investment, which you probably are going to do well. If you struck out on this one, just knowing your track record, right, and your confidence in yourself, you're probably going to do well in the next one. So it's this journey mentality rather than this destination.
I love it, man. And, thinking outside of the box, I think of this idea of invisible deals. And I guess I could relate it to the idea that when the pandemic hit, we learned this lesson that the middle income and below housing class does better than the high house, like rental housing class, right? Like we talked about this idea that if you are renting to folks that are using, you know, the best of their paycheck for the best housing that they can get to in blue collar world, it's very different than folks that are renting a home on the beach that can think, oh, you know what, I can take $2,000 off the table and now I can live off that cash flow as well. That seems like one of those like trends that you guys were able to hop on early as well.
And, you know, honestly, it's been that way pre-pandemic. It was exposed to a greater degree during the pandemic, but right, the reason that we focus on below middle income housing, even though it doesn't look as nice as houses on the beach, is because of commandment number 2 here. It's reducing the risk.
Yeah.
Right. When you are focused on below middle income housing, you have the ability to invest in something that is more secure simply by the dollars. Right. Right. You have the ability to invest in housing where people are living there and paying that rent, and it's not so much of a choice.
Yeah.
Right. And maybe that didn't come off the right way. Like, there is wonderful housing in below middle income housing, but they might not have the ability to buy a house. If you go to the above income housing, above middle income housing, you have folks that have the choice to rent or to buy, right? I would rather reduce my risk by working with folks that there's a financial need to be investing, to be renting, because that's going to reduce my risk.
Yeah. And, you know, here's another, you know, perspective. If you're willing to consider it, I could totally agree with you. And that's the whole reason I got into affordable housing.
Right.
You know, you have a financial crisis, middle income moves to affordable housing, right? So it's not like you lose your market, and we're already underserved. There's supply issues on affordable housing, right? So it's, I mean, this is a no-brainer. It's a home run all day long. It will continue to be, you know, long-term, affordable housing will be a winner through and through for eternity, right? Like, I mean, there'd have to be some major shifts that happen for that not to be the case. But one other thing to consider is I actually think the best returns lie on each of the extremes, right? So it's affordable housing and then the nicest, the best, the highest end, right? So I don't necessarily want to be in class A apartments. I want to own the nicest apartment in a city, right? I want to own the nicest home in a country club, or, you know, because there's ample opportunity there, because no matter how bad the economy gets, there will always be the top 1%. And so that's just another way of considering it. Now, most people, there's going to be a barrier to entry. Like, how do you get into that? How do you get into these properties that are 20, 50, $100 million? You know, I mean, some of these properties in certain markets, maybe they're $2, $5, $10 million, but it's way easier to get into affordable housing. It's way less risky. But just to, you know, put a little food for thought out there for people to think about, there's a huge opportunity in the highest end sliver that the top 1% is your customer of.
Interesting.
Yeah, that is, by the way, that's something that's become very apparent to me, right? Like, there is no top end of wealth, right? There is, like, once you get to a certain level, they're buying stuff. Yeah. And if you're playing in that space, they're going to be fine, kind of recession proof. Then there's the middle, and then there's the I don't know how to say this in a kind way, but the bottom rung of Maslow's hierarchy, the necessities, right? The things that we need, right? We got a great question here from Miguel Angel, who's asking, joining us from Spain, by the way. Miguel Angel, welcome, man. In a situation of uncertainty like this, what are the pros and cons of cash purchasing versus financing? And I think this kind of goes towards your commandment number 9, if I'm not mistaken.
Yeah, it certainly does. You know, I think some of it is risk tolerance. I think some of it is, you know, how bad do you think it's going to get? Can you dip into something else if a bank were to call your note? I mean, we're still close to historic lows. You know, we've had some upticks, so the interest rates aren't as great as what we've seen, but they're not bad. I mean, at one point in time, you know, within the last 10 years, these are the best rates anyone had ever seen ever. Absolutely. Right? You know, so let's keep that in perspective. I still think it's the cheapest money out there. And as long as it's not too aggressive of leverage, I think it's smart to use it. But I also think that it's good to have some backup plans, that just in case the note were called. And by the way, it probably won't be called, but just in case it were, think through, what would you do? how would you come up with those dollars? Who's lined up? Or do you have, a credit line that is big enough to cover whatever the bank might call? There are a lot of ways to look at it. Now, if you're not trying to maximize your dollars and you just need dollars to sit there, by all means, buy something in cash and refi later. But, at the end of the day, I think the more dollars you can put down as a down payment creates more cash flow, more lifestyle. You may get to a point where, and maybe, the person asking this isn't in a point in life where you need all the cash flow. So maybe it makes sense to just place cash and, just not have to worry about it and have some safe assets. And by the way, it goes back to, I don't believe there's right and wrong. I think there are good decisions and there are bad decisions, but often we don't know them until later. But I'd rather just look at it as a decision made. Here are the pros and cons to that decision. And everyone's situation is a little bit different. And so we have to evaluate it from the lens of them and their scope.
Yeah, I agree with you. I don't think there's a right and wrong as well, right? We have a lot of investors that come to us. We put a plan together for them to be purchasing in cash. And then some we put into a plan to purchase with conventional financing or non-recourse financing, right? It's totally dependent on more than just the return on investment expectation, right? It really is the lifestyle and where you are. But here's
if you can get non-recourse, do it all day long, right? If you can get that lined up, there's no reason in my mind not to do it.
Yeah, you're talking about non-recourse even for outside of your retirement accounts, right? A lot of times our folks are thinking about inside retirement accounts for non-recourse, but you're talking about some leverage that, outside of your retirement accounts, you can still get really good rates today, especially historically speaking, and actually not be on the recourse, the hook, if you wouldn't make the payments, which is interesting. We haven't talked a lot about that.
I haven't talked at all about that.
No, your rates aren't as good as what you would get if you accepted recourse.
Mm-hmm.
So we typically don't talk about it too much in terms of, and our clients typically don't do it for purchasing rental properties, but we use non-recourse loans when we are doing some of our investments in downtown Jacksonville or the Town and College Park Shopping Center and some of these other things outside of single family rental properties.
And if you have to roll them up, something that a lot of banks will do if your portfolio is big enough is they may give you that non-recourse if you basically finance them all with them. So that's another thing for, big enough players in the space. Once you get, I feel like some of the critical mass in the single family home space, and this is coming from a guy that's owned single family homes. I still own single family homes, just a lot less today than I used to. But, once you get to 10, there's a lot more economies of scale. Once you get to 40, it's like a whole nother level. Once you clear 100, it's, just a whole different stratosphere.
I'll give you some personal examples there. So, we own over 300. Well, a lot of those have debt on those, which are non-recourse.
There you go.
So, and the only thing I was going to add as far as the cash versus financing component here, financing has always afforded you a higher potential risk, or a higher potential return on investment. And the way you mitigate that is with cash flow, but financing largely the pros are like, I can get a better return on my money versus cash. Cash has had more cash flow. It's been that way before where we are in the pandemic and the low interest rates environments. But right now, when you combine historically low interest rates, which we still have, and historically high inflation, the argument for using smart debt is even stronger today than it was pre-pandemic, pre-market dynamics that have led to low interest rates and high inflation. So it's an even stronger argument specifically on that component, because when you take out debt, when you are taking that debt out and inflation happens, your dollars that you take home generally go up higher, but that debt payment cost stays the same. So you're actually winning more. We call it the inflation triple crown, right? When inflation happens in rental properties, your rents go up generally, your prices go up generally, because those are largely tied to inflation, because the cost of other things going up around them largely leads to that. But you also win the third leg of the triple crown by taking out smart debt, having those payments stay the same, while in theory, your income rises specifically because of inflation. So it's an even stronger argument today than it's ever been, because you have low interest rates and 7.9% CPI, consumer price index right now.
Justin, this has been amazing feedback in the chat. We got through only 4 of the commandments. So you're just going to have to buy this amazing book and get through all of them. Check it out. It's really, really good. Justin, I want to leave it with something that kind of is a through line through all of this. And it's the value of a network, the value of being surrounded by great people. I know that you run a really, really high level mastermind. Can you just kind of talk about your mastermind and who can apply to that, and the value of being surrounded by like great people like yourself and all of your author friends and people like Greg and stuff like that? Because I'm trying to push this guy to join, for the record.
I'm super interested.
Yeah. So what I'll say first and foremost is, for anyone that buys the book, all the proceeds go to a charity called Love Justice International. They stop human trafficking in 24 countries around the world, and it's just a much bigger problem than most people recognize. So whether you buy it on Amazon, or for anyone here that wants to get it, if you go to lifestyleinvestorbook.com, that's a free plus shipping opportunity for your audience that I'm happy to give. And again, regardless of how you buy them, the proceeds are all going to go to charity. As far as my mastermind, if you go to justindonald.com, that has, everything I do. So I've got, a podcast, I've got a blog. Obviously those are free. I've got an online course, a couple different master classes on passive income and mobile home park investing. And then kind of the crown jewel is my mastermind. It's called the Lifestyle Investor Mastermind. And it is a community of some of the brightest people I've ever been in the same room with, doing some amazing things in the world. The criteria to get in is high. So there's a big barrier to entry, but you can read all about it on my website. You can apply if you'd like. And if you do get in, there's a wait list right now because we closed the group when we hit 100 members, but we recently reopened it. And it's just some of the most impressive human beings that you'll ever meet. And I'm also very proud to say that it's, we're really close to a 50-50 split of men and women, which is very atypical in the financial space. I think we're at 60-40 right now. And I'm just really impressed and really proud of the whole crew and what they're doing. And most of the people that are in it are from recommendations, word of mouth of the current members. So it's a really special place for those that qualify for it. But again, if someone doesn't qualify, it's okay. I've got so many free items that are out there, or super affordable items. And so my goal is that, if I can take the information and I can create change and impact financial freedom, I think that's incredible. And if I can take proceeds and impact real life freedom and buying people's human rights back, I think that is a way I can leave a positive mark, on the world and make it a better place.
Awesome, man. When we talked prior to this show, it's just very obvious to me that you very deliberately, when you enter a relationship, you have a specific intent to leave it better, right? And you have this like effect on people, which is totally shown in the chat, where it's like you're clearly putting out a lot of value. You clearly are managing your energy in a way that makes people feel good, man. And I just really, really admire that in people. I really appreciate you being on board here with us. I want to thank our community that's been here, 55 plus people. This is a testament to your value, of course. 55 plus people, an hour of your day in the middle of a Tuesday. I mean, that is not a light ask, and you do it with us time and time again. And it's really, really great. If you're listening to the podcast, come be one of those folks, right? Like listen to your name on the roll call, get a nickname, like be a part of the fun. This has just been awesome, awesome, awesome. GC, I'm going to kind of give you last words, buddy.
Well, I'm going to say, you know what? There's a lot of folks that are listening on the podcast that haven't joined the Zoom meeting, but there's a lot of folks that are here that haven't chimed in on the chat, and they're one step away from getting an awesome nickname for you. So I appreciate everybody for being so active in the chat. And if you haven't been active in the chat yet, say something. We'd love to hear from you. You can join the fun as well. But Justin, hey man, I just really, really appreciate not just the things that you have taught today, but the things that you stand for. In the short amount of time that I've gotten to know you, I can really tell it's more than about delivering a return on investment, which is just something that I think it's a message that needs to be delivered. And so I sincerely appreciate you. And I really, really love chatting with you because I think you're kind of like my brother from another mother, man. Right? Like we think very similarly. We've had similar life experiences that have taught us. So I love sharing this message, and I certainly hope you'll come back on the show.
Well, I'd be honored to. And I love just the education that you're putting out into the world and the way that you're enabling other people to get into the game. And it's a game. Maybe not right away, maybe not with your first property, but once you're a few in, it's a game. And once you can let go of the grip of money controlling you and controlling the decisions you make, and get to a place where you're doing it more abundantly, you're looking at it more abundantly, and less about losing it and more about learning lessons, that's where it gets fun and everything changes. So hats off to you both for, Greg and Pablo, just, paving a way here for people to learn and help them, on their firsts all across the board and beyond.
All right, man. We will take it. I am one of those first that joined because of this stuff. Join us on Thursday when we go over the JWB Rental Liquor Property of the Week. And until then, don't be an average investor. Be a lifestyle investor. Pick up this book.
Go for it.
Yeah.